Hello everyone. My name is Amandeep Singh and I'm a CPA at Cloudiverse CPAs. My firm focuses on small businesses and we help the small businesses with their accounting problems and their tax problems. If you have set up your small business as a corporation, you have a choice as to how to pay yourself. Many business owners are unsure of whether to opt for salary-based earnings or payments in dividends. Usually, owner-managers want to withdraw cash from their corporations throughout the year and might use shareholder loan account to do so. This indecisiveness might lead to a debit balance in the shareholder loan account, which will be taxed in the hands of the shareholder without the benefit of dividend tax credit. If the balance remains unpaid for 2 consecutive balance sheet dates. In an attempt to make it easier for the owner-manager to decide whether to withdraw money in the form of dividends or in the form of salary, my video throws light on the pros and cons of salary and dividends. Let's start with the advantages of dividends. Dividends are taxed at a lower rate than salary, which can result in you paying less personal tax. Paying yourself with dividend is comparatively simple. You write a check to yourself from your corporation, and at the end of the year, you update your corporation's minute book and prepare a director's resolution for the dividends paid. A T5 slip which reports dividends paid by a Canadian corporation to its shareholder must be prepared and issued to you and to the Canada Revenue Agency. You use this slip to report an investment income earned in the year. Some of the disadvantages of declaring dividends are: first, receiving the dividends instead of salary can eliminate other possible personal income tax deductions for you, such as childcare expense deduction. You can only pay dividends out of profits made by the company. If there is no balance in retained earnings, well, dividends cannot be paid. Dividend directly reduces the equity of your plan company. For example, when a dividend of $50,000 is declared and paid, the corporation's cash is reduced by $50,000 and its retained earnings is reduced by $50,000. So both of them get reduced. Dividends are issued and paid based on share ownership. This can make it difficult to allocate different amounts of income to multiple shareholders if they are all own the same class of shares. Moreover, dividends are not an expense of the corporation, and therefore dividends do not reduce the corporation's net income or its taxable income. Receiving dividends doesn't allow you to build registered retired room, as dividends is not earned income. If you pay more in dividends, you can create a tax problem later on, and if the company becomes insolvent, you may be liable to repay the dividends taken. Banks and financial institutions prefer to see a T4 slip, which is for salary income with a stable salary, as opposed to a T5 slip with a dividend. You might be wondering, with little benefits and many disadvantages, you might want to choose salary as an option rather than dividends. Keep watching. Here are the advantages of using salary to pay yourself. Number 1, salary will count as earned income for pension contributions, that is RRSP. You claim your RRSP contributions as a deduction on your tax return. Childcare costs incurred are deductible against your salary income too. That's the second benefit. Help with financing purposes. If you are planning on applying for a line of credit or a mortgage, then paying yourself will help you qualify. Salaries paid by the company are an expense to the company and will be a tax deduction for corporations on certain expenses such as automobile expenses, which are incurred for work and are only deductible against employment income. Now, income splitting can be achieved by paying salary to related employees such as your spouse, your children, etc. There are, however, several traps to watch for. Any salary must be reasonable and commensurate with the nature of work that the spouse or children perform. As a rule, one can pay salary that is equivalent or even slightly higher than the market rates. Since the payment would be within the family, we suggest you to keep detailed records, as the Canada Revenue Agency will want cogent evidence for the deductions. Now, salaries are subject to Canada Pension Plan deductions. Paying your CPP now will increase your CPP benefits when you retire. Some of the disadvantages of declaring salary. you will be required to deduct income tax and CPP premium from your salary. You have the burden to do payroll. For example, you have to manage payroll, remittances to the Canada Revenue Agency, you have to prepare a T4 slip, and you have to calculate the source deductions and all of that. Common compensation strategies which we suggest to you. You only dividend to low-income family members such as spouse and children. Now, this can be done provided they are shareholders in the company and are engaged on a regular, continuous, and substantial basis in the business. With new law from January 1st, 2018, dividends received from the family business by adult family members will be subject to the new TOSI rules, which are tax on split income rules. I talk more about it in my next video. Beware that dividend paid to children may be subject to tax at highest rates because of the kiddie tax rules, whereas salaries paid to children are taxable at normal rates. For those of you who prefer saving for retirement on their own and aren't relying on the Canada Pension Plan or want to use their operating company, or better yet, a holding company, to accumulate their retirement savings on a tax-deferred basis, we often recommend this. Number one, a nominal salary of at least $5,000 per year to qualify for the non-refundable employment tax credit on their annual tax return, as well as to provide a base for disability insurance coverage through the nominal CPP premiums that will be triggered as a result. Number two, optimum salary to the owner, just to maximize the RRSP deduction room with any excess compensation requirements coming out in the form of dividends, often to an inactive spouse as well as to the owner. Additionally, if personal income is so low that the dividend tax credit would be unused, a salary may be more tax efficient. The other strategy is called bonus down strategy. Since $500,000 is a small business limit, the bonus down strategy works in many instances, which advocates to pay enough salary or bonus to reduce the company's taxable income to $500,000. Canadian corporations called CCPC pay income tax at a lower rate up to this amount of income, that is $500,000. This strategy works as long as the eligible dividend regime has been taken into consideration. For example, an owner-manager may attempt to income split with a family member who is not a shareholder or is not active in the business, in which case the CRA will disallow the excessive salary declared consequent to the provisions of Section 67 of the Income Tax Act. The amount of tax savings achieved by the bonus down strategy is different for everyone and is based on the number of years the funds are left in the company, and also the rate of return and whether the shareholders are disciplined enough to use company's funds. Once the after-tax corporation profits are paid out as dividends, then integration equalizes the tax. There are a lot of moving pieces and things to consider when deciding to pay yourself through salary or dividend, or even a mix of salary and dividend. The law is that the taxpayer must characterize, although not necessarily document, a payment as salary or dividend or loan at the time it occurs, and not recharacterize it by the means of general ledger adjustments at the year end. It is highly recommended that you consult with a professional accountant who can help you determine which option is more suitable for your situation and discuss other tax planning strategies to put more money back into your pocket. This video is being provided as general information only and is not meant as legal opinion or advice. Each situation is unique and should be reviewed on its own with the appropriate attention and care it deserves. Please do not hesitate to contact any member of a Cloudiverse team if we can be of further assistance in this regard. Thank you, friends, for watching this video on salary versus dividend. You have a good one. Keep rocking. Bye.